Tech in focus is the best performing S&P sector of 2019, up over 45% year to date. But as 2020 approaches, should investors expect more room to run for these names? Joining us now with their insights, LJH Advisors Managing Director Larry Haverty and Jefferies Managing Director and Senior Tech Analyst Brent Thill. Larry, let's start with you. My question for you, as you look at Facebook and Google in particular, will we start to see a real impact from all of the regulatory questions that have really been in focus this year but haven't started to hit results yet?
Well, I think both of the companies have seen the activities of the regulators. Google on a more piecemeal basis, I think, than Facebook. They've been periodically making fines or paying fines in various jurisdictions. And I think with both of the companies, the regulation is more or less a sideshow because at the end of the day, the thing that has propelled these stocks is threefold. One, it's really the best way for advertisers to reach consumers, and digital advertising is now over 50%, and I think it's probably going to stop somewhere at 65%. So that's a powerful thing. The second is the marginal profitability model. These people aren't paying for content. And when you get high revenue growth, which you're getting, and basically very little marginal cost, the free cash flow ramifications are very, very compelling. I think the thing that both of these companies ought to do is pay a dividend. I think the pileup of cash is increasingly becoming untenable, and they need to do what Apple did a few years ago and distribute some of it to the shareholders. But I just think the regulation, I pay attention to it, but it's a sideshow, and I think if you were to break these companies up, the sum of the parts would be worth more than the market's paying for them right now. So I don't view this as much of a threat.
Brent, do you agree? I mean, Facebook has talked about a deceleration in revenue, but a lot of that is also about this shift to a new business model that's really more about communication. You have a lot of questions about whether Google will be breaking out more information about its YouTube revenues. Do you think all the regulatory threats are just a sideshow?
I do. I've been saying that all year. Facebook's up 57% year to date. At the beginning of the year, no one wanted to buy it because of regulatory. Go back to Microsoft. Did that impact Microsoft? No. Nothing's going to impact Facebook or Amazon or Google from a big regulatory perspective. They all have the same risk. So we've been saying the same thing in the entire year. It's going to be the same issue next year. There's going to be headlines of lawsuits and issues. But I think you go back to the core, these companies are changing the way that we operate our lives. And we think that they're critical stories that have big moats, that have major competitive advantages that others aren't going to catch them. So we continue to believe that these are still very valuation. There's valuation support. Some of the software names that we cover are trading the stratosphere in terms of multiples. And this is, I think, why Google's up 30% year to date. They implemented a buyback. They're doing more shareholder-friendly things. We think, again, that the backdrop still looks pretty favorable for large cap internet, and specifically for Amazon, given how Amazon's lagged this year in 2020, we think it can recapture some of the lost performance relative to the other names that we cover.
Larry, Netflix. It's up 25% year to date, but over the last 6 months, it's down 9.5%. All the competition fears, are they overblown?
I think the competition's very real. I'm really looking forward, Julia, to the fourth quarter release for two reasons. One, we'll get metrics from Disney Plus, which I think are going to blow people away. And the second thing, I'm interested in the amortization on The Irishman. Between release costs and production costs, The Irishman costs $200 million. Is my best guess, and I wonder how much of that's going through the income statement. The other thing that bothers me about Netflix is that the market's been very, very cavalier about valuing foreign subs at the same value as domestic subs, and this is really a myth. The revenues are a lot lower. There's, as new markets are entered, the necessity to construct local content, which doesn't have the scale economy of English content. The foreign growth, in my opinion, here is a much lower quality, and the multiple is still, I think you pay 3 or 4 times as much for Netflix to create $1 worth of content cash flow as you do for Disney. So I'm quite cautious about Netflix from here, and I think the odds are pretty high that it continues to underperform, especially if, God forbid, we live long enough to see interest rates go up. If interest rates start going up, all of these companies are going to have problems because the valuation affords no margin of safety for most investors.
Brent, do you want to have a final word here on Netflix? Netflix does say that it will start to break out some more granular numbers about those international subscribers. What's your expectation?
Yeah, we don't cover Netflix, so I can't really comment. We continue to believe that there is money flowing out of Netflix into the other large cap names from our trading desk, given the overhang of some of the other streaming services, as you've talked about Disney Plus. So from a trading perspective, we continue to see money flowing into other stories that we cover.
Larry, Brent, thanks so much.